Morning, ladies and gentlemen, and welcome to Cepsa's third quarter 2020 results presentation. This is Gonzalo Sáenz, Cepsa Head of Finance. Before we begin, please let me take a moment to flag that financial information contained in this document is unaudited and certain figures are non-IFRS. This webcast, including the Q&A session, may contain forward-looking statements. These statements reflect the company beliefs, intentions, and correct expectations concerning, among other things, the company's results of operations, financial condition, liquidity, prospects, growth, and strategies. Forward-looking statements are not guaranteeing of future performance of the company. Please take a moment to read the disclaimer on the first page of the presentation. You may send us your questions through Slido during the whole presentation. To do so, please go to slido.com and enter the passcode showed on screen, Cepsa results. You may post your questions at any time, and we will address them at the end of the session. I kindly ask you to please identify yourself when posting your questions so that we may refer to you when providing answers. Today's conference call will be conducted by Salvador Bonacasa, Cepsa's CFO. So, without further delay, Salvador, the floor is yours.
Thank you very much, Gonzalo. Good morning, ladies and gentlemen, and thank you for joining us today for Cepsa Q3 2020 results presentation. This is Salvador Bonacasa, Cepsa Chief Financial Officer. First and foremost, we hope that you and your families, friends, and colleagues are all in good health, given the current circumstances. In today's presentation, we will take you through some key highlights of the third quarter and first 9 months of the year, and provide you with some reflection on what has been a quite challenging environment since March, with the COVID-19 pandemic affecting, to some extent, all companies in all sectors. Let's start our presentation with our highlights for the Q3. As you can see in the screen, firstly, it is worth highlighting that during this whole period since the onset of the COVID-19 pandemic, our priority as company has been to protect the health and safety of all our employees, clients, and suppliers, while ensuring the continuity of our operations to guarantee the supply of essential energy products and services to society. Operations have been running smoothly during the quarter, with all key assets and industrial plants operating normally. We have seen some signs of recovery, especially in the upstream and marketing businesses, with Brent reaching an average price of $43 per barrel in the average of the third quarter versus $29 per barrel in the second quarter. And, on the other hand, higher volumes in marketing derive from the easing of lockdown measures through Europe and the summer holiday season, especially in Spain as our main geographic landscape. Our chemical businesses continue to outperform, delivering value to Cepsa and society at large, being the first producer of LAB worldwide, utilized in detergents and hygienic products, which are extremely important these days. In terms of financial performance, Cepsa has generated an EBITDA of 277 million euros during the quarter, with an accumulated for the year of 910 million euros. And this reflects the company ability to perform despite the challenging market environment. Cepsa also posted a positive operation cash flow of 224 million euros from July to September, which represent a significant increase of 154% versus Q2 figures. At the start of the COVID-19 pandemic and in response to the deteriorating market and economic condition, Cepsa put in place a contingency plan with a range of actions aimed at protecting cash flow generation for the year, This plan, which targets savings of 500 million euros by year end, is progressing well, with a 78% or 390 million euros in savings already captured as of the end of September. These savings are split between CapEx and OpEx savings. In addition, during the third quarter, Cepsa has continued to work on reinforcing its liquidity position, which is now in excess of 4.6 billion euros, and extending its debt maturities, with an average debt maturity of 4.2 years. We will go into further details latest in this presentation. Finally, in terms of corporate events, I wanted to highlight Cepsa's successful execution of its last bond issue in July, a new 500 million euros long 5 years bond, as well as the acquisition of a 40% stake in 2 asphalt companies leaders in Morocco. That reinforce our presence in that country and support our long-term strategy. Moving on to slide 6, you may see the evolution of the main external variables that affect our businesses: crude oil price, refinery margin, euro-dollar exchange rate, and automotive fuel demand in Spain. Regarding crude oil price, during the third quarter, the OPEC Plus agreements, coupled with the effect of positive macroeconomic data and the stimulus measures put in place by central banks and governments, together with the easing of lockdown measures, led to a rebound from $30 per barrel area in Q2 to $45 per barrel, where they have stabilized. On the other hand, refining margins have registered their minimum levels in the last 10 years, with an average value for the quarter of $0.5 per barrel, derived from the increase in crude price, while distillates cracks remain under pressure on the back of the inventories built up in previous months. As per the euro-dollar exchange rate, during this last quarter, we have seen the US dollar gradually depreciating versus the euro, affected by the extension of COVID-19 cases across the US and the uncertainties around the elections. Finally, automotive fuel demand, you can see in the graph just in the right side of the slide, has recovered remarkably in comparison with 2Q levels, mainly due to the end of mobility restrictions and the summer season in this period. On slide 7, we have a comparison of key operation of financial figures in 3Q versus in comparison with 2Q. As you can see, we have experienced a strong improvement in all key metrics, which enable us to be cautiously optimistic as we move to the end of the year and the beginning of 2021. With regard to the realized oil price, we have seen a significant recovery from $28 per barrel in 2Q in the second quarter, up to an average of roughly $43 per barrel, which represent an improvement of 53%. In refining, the production and the utilization of our refineries have both improved by 12% and 90% respectively versus or in comparison with the previous quarter, in line with market demand as mobility restrictions were lifted. The operation flexibility and strategic location of Cepsa refineries enable us to be constantly adapted to the market requirements. Marketing product sales rebounded from 3 million tons to 3.8 million tons, which represents an increase of 30%, with our networks of stations being the main driver of this increase. Finally, chemical product sales, which were already strong, remained stable at similar levels to those registered in the second quarter. Moving on the financial metrics, there has been a remarkable improvement in all of them. In this sense, it is worth highlighting the positive net income achieved in the quarter of 39 million euros versus the negative figure of the second quarter of minus 93 million euros. Cash flow from operations registered as well a significant improvement of plus 159% versus second quarter, reflecting the company's ability to perform even under the current challenging circumstances. Lastly, net debt has been reduced by 9% or circa 300 million euros in comparison with the end figures of the second quarter, standing currently at similar level that at the end of 2019, mainly due to the contingency plan put in place at the start of the crisis and the company efforts in control of the working capital management. We have also improved somewhat the total liquidity position of the company, which stands now in excess of 4.6 billion euros. Moving to the next slide, we would like to comment the COVID-19 impact on the performance of each of our businesses. I would like to start by saying that thanks to the dedication and professionalism of all of our employees, the supply of energy products and services to our customers and society at large has been a priority and has been guaranteed at all times. During these extraordinary circumstances, Cepsa has maintained its industrial facilities operational and has continued to fulfill its role as an essential industry. Regarding the upstream business, COVID-19 has had a limited operational impact to date, apart from the decrease in production levels driven by OPEC quota restrictions affecting our operations in Algeria and the Emirates. Crude price have stabilized during 3Q post-OPEC deal in a range between $40 and $45 per barrel as economies were reopening and crude demand recovered. Moving to the refining business, it is worth mentioning that in such a challenging market environment, Cepsa refining businesses has demonstrated operational flexibility and the ability to optimize margins thanks to the strong level of integration with other businesses, mainly marketing and chemicals. As such, we have been able to mitigate in part the depressed refining margins which registered their lowest level in Europe over the last 10 years. Moving on to marketing, the COVID-19 crisis has affected differently the business segments within our marketing businesses. We have seen dramatic drops in demand in, for instance, aviation fuels, while other segments, such as wholesales and asphalts, clearly outperforming even the budget for the year. During the third quarter, the demand for oil products recovered from the depressed level registered in the Q2, derived from the summer holiday season and the end of the lockdowns and mobility restrictions put in place in Spain. Year on year, automotive fuel demand in Spain has roughly 10% below the same period of 2019, showing, however, a clear rebound from April and May figures, in which the decrease reached more than 60%. Lastly, in our chemicals, the COVID-19 pandemic has had a positive impact, especially in the LAB segment, as LAB is the raw material used for detergents production, which are currently in high demand. Plants have been operating at full capacity throughout the period. The global leadership position of our chemical businesses and its resilient nature have proven to be a competitive advantage in the current market environment. About our contingency plan. In the month of April, Cepsa put in place a contingency plan comprising several initiatives targeting 500 million euros in savings, with the aim to protect cash flow generation for the year and strengthen its balance sheet. These initiatives can be divided into operational and financial. In terms of operational initiatives, we target OPEX savings of 120 million euros across all business units and operations. Postponement of capital investment projects totaling 380 million euros. Of these 500 million euros in total savings, 390 or 78% have been already captured as of September. In addition, taking advantage of the historical low commodity prices during Q2, we hedged a relevant portion of 2020 energy cost of our industrial plants, and we have used available storage capacity to profit from good contango trades in some situations. Finally, we continue to work on optimization opportunities of the company's working capital. In terms of the financial activities, you can read that at the end of the slide, I would like to highlight our efforts to further improve the company's liquidity position. In this sense, since March, we have executed new committed banking facilities for a total amount of 1.1 billion euros. We have accessed the debt capital markets twice with two 500 bond issues, which achieved large oversubscriptions. And we have reinforced our liquidity position to a total of 4.6 billion euros and extended the average debt maturity profile to 4.2 years. Now we can move to the slide number 13 on the short-term outlook. We would like to review the short-term market outlook for the different segments that we have, the different business that we have in the company. Firstly, it's worthwhile highlighting that for the last quarter of the year, we are somewhat cautious as the second wave of COVID-19 infections spread across Europe, with a number of countries, including Spain, reinstating mobility restrictions that are affecting negatively the demand for oil products. A further commentary on the individual business segments. In upstream, we expect oil price to remain stable in the near term. Production is expected to remain at similar levels as OPEC restrictions are likely to be extended until year-end. In refining, margins are expected to remain under pressure in the near term due to the COVID-19 second wave and subdued demand. Refineries utilization is expected to remain at similar levels in the short term and gradually increase as economies reopen, probably the next year. In marketing, as already mentioned, we saw a strong recovery in volumes in the third quarter, but nevertheless, the second wave of infection is putting again some pressure on demand, which we expect to decrease somewhat versus the previous quarter. Margins are expected to remain healthy. And finally, in chemicals, we foresee a strong performance to continue, especially in the LAB segment. We are stable to higher margins in the near term. Well, we can move just now to the results for the first 9 months of the year. And if we move to the slide number 15, our working interest production in thousands of barrels per day was 77,000 barrels per day equivalent, compared to 94 in September 2019, due to the already mentioned OPEC quota restrictions affecting both Algeria and Abu Dhabi. Realized crude price in the first 9 months was $40.9 per barrel, well below to 2019 levels, but with a significant recovery compared with the second quarter. A slight increase in upstream OPEX from 9.9 to $10.0 per barrel due to the slight different mix in production as a result of OPEC quota restrictions. Cepsa refining margin stood at $2.6 per barrel versus 4.5 during the first 9 months of the year 19, as results of the decrease in the demand for oil products due to the COVID-19, which lead to narrower middle distillates and gasolines crack spreads and light to heavy crude oil spreads also. Utilization rates at the refinery stood at an average of 81% during these first 9 months of the year, adapting to the decrease in demand, but improving 74% versus the second quarter. Marketing products, marketing product sales decreased mainly to the lockdown measures taken during the second quarter, but the gradual reopening of the Spanish economy from May and the summer season increased the volumes for Q2, totaling 11.1 million tons from January to September. Finally, in chemicals, product sales have been slightly below 2019 levels. However, we have seen improving margins in all segments. If we move over the slide to slide 16, we wanted to share with you some of the key highlights of the first 9 months of 2020. Despite the impact of the COVID-19, which was particularly acute during the second quarter of 2020, cost savings put in place and our integrated business model has proven its strong resilience in these difficult circumstances. As such, Clean CCS EBITDA during the first 9 months of 2020 was 910 million euros, decreasing by 41% versus the figures of 2019. By business unit, you can see upstream registered an EBITDA of 337 million euros, down 53% year-on-year basis, driven by lower realized crude oil price and lower production due to OPEC quota restrictions. At free cash flow level, however, upstream is somewhat less affected due to the reduced tax. These businesses accounted for 37% of group EBITDA as of September 2020. Refining registered 34 million euros of EBITDA during the first 9 months, down 90% year-on-year basis due to a weaker refining margin environment and lower production, as refinery runs have been adapted to market demand. Refining accounted in these 9 months for 4% of gross EBITDA up to the third quarter. Marketing EBITDA was down 10% year-on-year to 307 million euros, driven by lower demand following the lockdown in Spain and despite improving margins. Gradual reopening of the Spanish economy resulted in increased volumes since the end of May, and marketing accounting for 34% of group's EBITDA in the first 9 months of 2020. Chemicals registered an EBITDA of 256 million euros, up to 38% year-on-year, mainly as a result of the strong performance of the LAB segment and improved margins, as previously mentioned. Chemicals accounted for 20% of group's EBITDA. Corporate costs were down 31% year-on-year basis as a result of cost savings initiative related to the contingency plan put in place. Regarding other key financial metrics, Clean CCS net income stood at 31 million euros for the first 9 months of the year, affected from low crude oil prices, the low refining market environment, and the decrease in demand due to COVID-19. Cash flow from operations before changes in working capital was 663 million euros, which shows Cepsa's resilience and ability to generate positive cash flows even in the current challenging market environment. Investments have decreased by 21% year-on-year as a result of the contingency plan put in place to preserve cash flow generation. And just now, probably Gonzalo can follow the presentation in the slide 17 about cash flow and other financial metrics.
Yes, thank you, Salvador. So if we take a closer look to the cash flow statement on slide number 17, so during the first 9 months of 2020, as already mentioned, cash flow from operations before working capital stood at 663 million euros. In terms of taxes paid amounted to 222 million, which is 22% below year-on-year. This is due to decrease in taxes is mainly due to the different advanced tax payments between 2019 and 2020. In terms of working capital, it remained flat with respect to 2019 levels, although we aim to register a significant improvement versus Q2 figures of 226 million as a result of our efforts to optimize this specific caption. In terms of CapEx for the first 9 months of the year, we invested 590 million euros, mainly being driven by development of assets in Abu Dhabi and a number of projects in the refining and chemicals plants aimed at improving efficiency, as well as the acquisition already mentioned of a 40% stake in 2 asphalt companies in Morocco. As you may see, most of the CapEx disbursements up to September were related to discretionary growth projects, which represent roughly 70% of total CapEx. As such, despite the decrease in cash flow from operations versus 2019 of roughly 50%, Cepsa generated positive free cash flow before this discretionary growth CapEx during the period of roughly 300 million euros. Now moving on to the balance sheet and liquidity position. So Cepsa maintains a quite robust balance sheet with net debt of 2.9 billion as of the end of September, which is virtually flat versus 2019, and a net debt to EBITDA ratio of 2.2 times. Following the onset of COVID-19, Cepsa has focused on reinforcing its liquidity position and terming out a number of its short-term facilities. In this sense, Cepsa has carried out a number of actions, such as the renewal and extension of existing short-term credit lines in excess of 700 million euros, the signing of new liquidity facilities for a total amount of 1.1 billion euros, 2 bond issues executed in February and July with maturities in 2028 and 2026 respectively, and the 1-year extension of its 2 billion club deal facility with maturity now after this extension in September 2025. As a result, as of the end of September, Cepsa holds a liquidity position of 4.6 billion euros, as already mentioned, which is enough to cover debt maturities up to September 2025. On the next slide, here we may see the debt maturity profile of the company. So with the maturity extensions that we just mentioned executed and the 2 bond issues also executed during the year, the current average maturity profile of Cepsa debts stands at 4.2 years. Cepsa holds a strong cash position, which as of 30th of September stood at 1.7 billion euros for a total liquidity of 4.6 billion. As you may see there on these slides, Cepsa hasn't got any significant maturities up to 2024. Finally, it's worth highlighting the ratings. So as you may see on these slides, Cepsa investment grade ratings were affirmed post the onset of COVID-19 by all three rating agencies. Both Fitch and Moody's confirmed Cepsa's rating in April at BBB- and Baa3. Moody's changed the outlook from stable to negative, and this is due to concerns in the sector in general. It's not a specific credit issue on Cepsa. And lastly, during the month of June, S&P also confirmed Cepsa's BBB- rating with a stable outlook. It is worth highlighting and emphasizing that both Cepsa, the company, the management, and its shareholders are fully committed to investment-grade ratings. It's a key priority for both Cepsa and management, and as such, we will continue to observe conservative financial policies, commensurate with these investment-grade ratings. So with this, we conclude today's presentation. Salvador, I don't know whether you want to do a final note.
Before moving to Q&A section, I would like to say that we are cautiously optimistic about the future, with probably the worst part of the COVID-19 pandemic behind us, despite the second wave of infections affecting currently the vast majority of Europe. However, the positive news about advancing on the vaccine give us a certain optimism when looking at the end of the year and the beginning of 2021. In addition, from a financial point of view, we have significantly strengthened the liquidity position of the company and term out the maturities, and therefore believe that we are very well equipped to cope with any future uncertainties. Our integrated businesses model has also improved to be quite solid and strongly resilient in these challenging circumstances. For further details on Cepsa results, I encourage you to refer to the press release and quarterly report which will be published on Cepsa website right after this call. Thank you very much for your attention. Gonzalo?
Thank you very much, Salvador. So we will now move to the Q&A session. Before we move on to the session, just let me remind you once again how you may direct us your questions. You may go to slido.com and enter the passcode showed on screen, Cepsa results. Once on the event page, you may type your questions in the dialog box. I kindly ask you to please identify yourself so that we may refer to you when providing answers. Many thanks. Okay, so we have some questions from Simone Mittal from Schroders. What is your guidance on 2020 and 2021 upstream production? Should we expect 2021 capex to be similar to 2020, around 800 million euros?
Thank you very much for your question. Regarding to the crude oil production, the upstream production for the next year, we are very related with the general policy that OPEC Plus will decide in the short term or for the whole year. Just now there are some quota restrictions on the market, and we expect that this will be maintained in the short term until the COVID-19 situation change. We have in the same situation, probably we have the same level of production for 2021. And the capex, I understand you refer to the global capex of the group, 800 million per year. Well, we need to review in the same line that we have in this 2020, we need to review every day, every month, all the investments, all the OPEX activities in order to be sure that we maintain our investment grade in the market. No? This will be a priority for the company, and this will drive the investment efforts for 2021 also.
Okay, thank you, Salvador. So we have another question. Refining margin was weak in the third quarter of 2020. What are we seeing now, and what should we assume for 2020 refining indicator for the whole year, I guess?
Yeah. Well, the refining margin was very weak, as you mentioned, and as we told before, mainly due to the concurrency of several circumstances. Crisis in the refining sector around Europe, and the COVID-19 impact that implies a reduction of the running rate for the refineries mainly in Europe. No? Well, we understand that this scenario will be maintained during the first quarter of the year, but we expect that after COVID-19 resolution of the current situation, these margins would improve something during the year. No? Probably not to recover previous margins that in the past, in the levels of the past, but a significant improvement from the 2020 refining margin that we have.
Okay, thank you, Salvador. And another question on fuel demand. So fuel demand recovered in Spain strongly. Would you say the same recovery continues in Q4? Are we above pre-COVID levels already?
Well, sorry. As we mentioned in the slide number 7 of this presentation, the fuel demand in Spain suffered a lot in the first quarter, after the first quarter. No? With the beginning of the confinement in March, the total reduction of the fuel demand in Spain in April, for example, was higher than 60% in comparison with April 19. Some recovery was, we saw some recovery in May, some recovery additionally in June, and in July and August, the total fuel demand is more or less 12% lower than the previous year, the same month of the previous year. No? In September, it was more or less 7%. Just now, in the last quarter for the year, well, there is a seasonally reasons also that could impact in this evolution, but we expect to remain at the same levels of the third quarter, between around 10% lower than the previous year in the same months. But we don't expect to be above the pre-COVID levels in 2020, and probably in the first half of 2021 neither.
Okay, thank you. And we have a final one. Can you provide some guidance for cash interest and cash taxes for 2020, and whether we have any change to dividend policy?
¿Puedes contar dónde? Cash interest? Cash interest. Well, we don't see major difference for cash interest payment in 2021, and the cash taxes in Spain. Well, probably we have some credit taxes generated in 2020 that we need to apply in 2021 as at maximum. Regarding to the dividend policy, well, this is a matter of the board of directors that will be reviewed. As you remember, the board of directors, the shareholders, the Cepsa shareholders, decide in March don't pay any dividend until the current situation with COVID crisis, with OPEC plus restrictions, with the current situation around all the businesses will be more clear. Just now, the board does not decide anything additional to decision, and well, we need to review at the end of the year, taking into account not only the final estimations for the year 2020, but for the first half or year 2021, in order to decide what will be the dividends for both years. But probably we need to be very cautious in order, in the same line that another lines of our prudent policy, financial policy.
Okay, so I guess this concludes the Q&A. No, sorry, there is one more. Hold on a second. From Pedro Castro. Dividends from associates. How much has been this amount year to date and year to date September 19? Okay, so for such detailed figures, we are going to post a quarterly report shortly on the web page, and you may have all these details there, so you can consult this probably in the next half an hour. Okay. Okay, this is it. No more questions. Okay, thank you very much for attending today's presentation, and I hope you all stay safe given the current